What I'm about to explain to you is something that everybody needs to understand, and you need to take it seriously. One of the sly roundabout ways to trick people is to convince them that 2 to 3% inflation was good for society. Over the weekend, the US national debt hit 40 trillion, and it is ballooning up and is skyrocketing. It's not just a matter of the United States debt, but most of the countries within the G7, Japan being the highest and the biggest holder of US treasuries, are going through sovereign debt crises. Last week, I made a really detailed video about the yen carry trade unwind and how that has repercussions that could impact the entire financial system. But the key is that you have to understand is that the denominator matters. If the denominator of dollars continues to balloon up, which it will, because the dollar is backed by nothing but debt, all the dollars that you earn at work continuously get devalued and debased. Hence the reason why when you go to the store or you buy anything in general, your money is melting, buys less. Most people only factor in CPI that's reported from CNBC, that's reported from Bloomberg, the Wall Street Journal, because they want you to understand only one side of the equation as it pertains to inflation. But nobody talks about monetary debasement and the crippling effects of that. Exhibit A, 10 years ago, a 30-year mortgage was 3.4%, and the median existing home price in the US was $250K. Today, the 30-year mortgage rate is 6.7%, and the median existing home price is $446K. So as a result, let's say that's a $39,000 increase in the down payment, assuming you put 20% down, which most people don't. They put down maybe 2%, 3%, and they get like a FHA. But an 160% increase in the monthly payment from $887 to over $2,300. Most people will look at this and they'll think, well, yeah, I mean, if you just bought the house, you would have been good. But at the end of the day, the debt is the asset. The debt is cheaper in low interest rate environments. And as a result, they need to keep rolling over new debt, increasing the denominator of debt in the system in order to prop up and inflate all of these assets. That's what you're going to see. You're going to see a wider and wider gap between those that are closer to the money printer and have access to cheap capital to buy up more assets, and then smaller and smaller amounts of people at the bottom and even in the middle that can't really afford to keep up with that because their dollars, because their currencies are constantly being debased. This isn't even really up for a debate. This is mathematically true and a fact. Most people haven't read into the history of monetary history, understanding different empires, understanding the rise of the British Empire, the Roman Empire, the Dutch Empire, and how any fiat currency by decree that is essentially used to tell people this is what you get paid in, it's being printed and it's manipulated constantly. This is a fact. So you can take this information as you may wish. You can act on it in whatever way you want. But what I always try to tell people is that the denominator matters. You want to own scarcity. You want to own things that can't be printed. And if you continue to think and trust that the system as it currently stands is going to be, sustainable, it's not. What's going to happen essentially is you will see bigger balloons and bigger crashes. And every single crash centralizes the power within those people who have access to the money printer, who have access to the cheap capital to buy up all the assets at your expense. This is why it's very important to understand that the denominator matters. It's very key and very critical to understand what's going on and to do research. And of course, like I say, don't trust everything that I'm saying. Go verify it for yourself. If you want some light reading, check out this book, The Creature from Jekyll Island. It'll give you a lot of context around what I'm saying, and maybe you'll learn something new.